And we'll give folks like 60 more seconds to join, and we'll get started. Hi, everyone who just joined. I'm admitting people. See folks popping in. Hi, everyone who just joined. This session will be recorded. If you would not like to be in the recording, which will be accessible to WIFPA members, go ahead and turn off your camera. Okay, so I think we will go ahead and get started. My name is Angela Steele. I'm a Senior Development Project Manager at Stone Sherritt Consulting Group and a member of Women in Housing and Finance Pennsylvania. Thank you all for joining us today for our third Thursday. This is our monthly networking and professional development event where we hear from great speakers, different topics, and get to connect each month. If you are not a member of WIFPA yet, definitely check us out at wifpa.org and learn more about becoming a member. Today, we're going to be talking about the Developer Opportunity Fund and LIHTC guarantees, and we have some excellent speakers. We have Rada Lisitsa from Wells Fargo, Chris Paul from Diamond Associates, Laura Northup from M&L Associates, and hopefully we will have Robin Weisman from PHFA hopping in anytime now. I know most people on the call probably have experience with LIHTC guarantees, but for those who don't, we're going to get an overview on what are the common LIHTC guarantees. We'll hear about how they create barriers to growth for developers and specifically hear some developer stories and examples of this. We'll share some of our key findings from our working group that has been meeting to kind of find solutions around the challenge of guarantees, and then hear about the PHFA Developer Opportunity Fund. And I will turn it over to Rada.
Thank you, Angela. So to start, let's talk about the construction loan guarantee. And this guarantee is pretty self-explanatory. It's for a repayment of the construction loan. This guarantee, of course, is important, but I would argue probably not as important as some of the guarantees on the investment side, because the construction loan lender has collateral, which is the land or any real estate that's built on that land, and typically has recourse, meaning that the lender can go after the guarantor's other assets. So switching over to the investment guarantees, there's no collateral and there's no recourse. So a strong guarantor is important, as well as an experienced developer. We want to be sure that the project will be built and will be able to operate properly. So the sponsor guarantees completion of the project in accordance with the plans. And then further, the sponsor also guarantees the project will achieve stabilization, meaning a certain occupancy and a 115 debt service coverage ratio is achieved for 3 consecutive months. If costs come in higher than anticipated, the sponsor pays for this developer fee. And then if stabilization is not met, then the perm loan would need to be resized. Or at Wells Fargo, we've come up with a mechanism where we'd ask the sponsor to create a reserve for the shortfall to the 115 debt service coverage ratio if they're not able to, or they don't want to resize with their permanent lender. So again, this would come out of the sponsor's developer fee. The completion guarantee is unlimited until stabilization occurs. And then after, the guarantee is limited to 6 months of expenses, including replacement reserves and debt service. And this is the operating deficit guarantee. This guarantee is significant because as an investor, we want to make sure that the property is operating above break even and the property is able to pay its debts, so there's no foreclosure. This guarantee typically lasts for 5 years, and it will be released if the project operates at a 115 debt service coverage ratio for the last 12 months. So any failure of funding any operating deficit loans typically allows the investor to remove the GP. Now the tax credit guarantee. This is for the compliance period of 15 years, and this ensures that the anticipated tax credits are received and there's no recapture, there's no compliance and or tax issues. If there happens to be any issues, typically the GP will be obligated to repurchase the investor's interest. So for nonprofits, our covenants typically start at $1 million for liquidity and $5 million for net worth, typically because nonprofits aren't flush with cash. However, the covenants can increase for for-profits and can continue to increase if the bank has a lot of exposure with a certain client, meaning that there's more aggregate risk. So all in all, investors are very focused on sponsor financials and experience and ensuring we have a strong guarantor so that if any of the guarantees are called, the sponsor would have the money to repay them. So I will note that recalls rarely happen in our industry. So that's the overview, and I'll now pass it on to Chris Paul.
Hi, everybody. So I'm talking about barriers to growth. And I don't know if folks saw the recent op-ed in the Washington Post from the editorial board called "Narrowing the U.S. Wealth Gap is Important. Narrowing the Racial Wealth Gap is Urgent." And I pulled a few quotes from the article. "Thus was the dispossession of Black people, which began with enslavement and continued through the Jim Crow era, compounded and perpetuated within living memory, and I would argue to this day. The racial wealth gap is not the outcome of impersonal market forces, but the legacy of oppressive policy." Across industries, the gap persists across the, we know that, right? But in our industry, affordable housing funded by low-income housing tax credits, the guarantees outlined are an unnecessary barrier to growth. Those who work in this industry or have worked for decades can tell you that we didn't always have these high barriers. The walls developed more recently, and they're very difficult to surmount. And Angela will be sharing some data that we gathered about how often they're called. The history of affordable housing production across all programs has always been characterized by the inequities produced by racism. Wealth built from the development of affordable housing prior to and during the LIHTC programs has been overwhelmingly enjoyed by white men, as we know. People of color have rarely had the opportunity to enjoy the same benefits and are more often maybe the residents of the affordable housing. The Developer Opportunity Fund is an it's an effort to break down one of these barriers that was created and has been sustained during the LIHTC system. And unless we have something like this put in place, and we commend PHFA for taking this step of putting aside money, the barriers will continue to characterize the industry, and we will continue to be an industry that's segregated, right? So we gathered at the outset of our gathering as a working group. We gathered some stories from a couple developers, and Laura is going to get into more specifics, but just generally, I thought it'd be helpful to give some highlights, and the slides provide a few highlights. Undercapitalized developers may generally find third-party guarantors to lend balance sheet. However, that's at the cost of 50 to 75% of developer fee, and sometimes more than that. The difficult experiences that some of us have witnessed have included developers who found third-party guarantors and lost those third-party guarantors because the economic position of the guarantor changed and they had to find another guarantor. the third-party guarantors are taking over 50% of the developer fee in exchange for only the work of providing wealth. So not the heavy lifting or the work. Like we all know it. I think everybody on the calls does this work, right? And knows that how much work is involved. The developers are doing all that. They just don't have the money in the bank. And you know, the handover fee in exchange for wealth. So it's, you know, that's inequitable and shouldn't be something any of us accept, right? So I think we in our office, and I mean, and in the working group, you know, people are getting through the gamut, getting a third-party guarantor and left in the same position. Now they have the experience of having gone through a deal, but they don't have any of the money from that deal. And so they're back to square one with having to engage a guarantor again externally. So that's not okay. And that's what we really want to see something like the Developer Opportunity Fund take down this one barrier, and then we can look at the many other barriers out there. So I wanted to turn it over now to Laura, who can give more details on a particular deal.
So M&L has had the privilege to work with TLC work-based training programs on the TLC Cornerstone Renewal Project. It is a $17.5 million project that is located in the Allison Hill section of the city of Harrisburg. Anybody who is familiar with the city knows that that is a predominantly minority area with a tremendous and great need. It is a mission. TLC is a mission-driven developer, a minority developer, Section 3, as I said, nonprofit. Not only is this particular developer attempting to revitalize an important section of the city, they also provide training to those formerly incarcerated or those that are typically hard to place individuals to gain meaningful employment. So there is an aspect of this developer that provides the employment and then the housing for those as they move forward in life. The project itself is 50 general occupancy units with set-asides for those formerly incarcerated and Section 811. It's a unique mix of a third-story building plus duplexes over a 2-block radius. So again, tremendous impact. And PHFA has been supporting this project since 2019 through many different issues, including the guarantor. Every deal, as we know, is different. Investors take different approaches depending on the developer's experience. It can even include background checks, CRA need, location of the project, and other items. Because this project is located in Allison Hill, we have a developer who doesn't have a great deal of experience, has some issues from their former life. We had difficulty even finding an investor. I called probably over 10 people in order to obtain one letter, which we did get from RBC. That gives you just an idea right from the start that there's struggles from the very beginning. Put on top of that, the guarantees that need to be in place through the first 15 years, and you're starting already at a deficit. In this case, because the developer is anticipating needing additional funds from PHFA, there could be the requirement of an additional 25% reinvested developer's fee. If we go with the current opportunity fund as proposed, there is a 10% reinvested fee up to $150,000, which would only be in place through year 15 or stabilization. Our biggest problem is then what happens in the final 10 years, which means then we have to bring in another guarantor, which is typically for-profit, that is merely coming in order to obtain more of that developer's fee. And although Chris, I think, said 50%, we've dealt with as much as a split of 80-20. So if you already have someone who's giving up 25% and then 10%, and then someone else wants 70% or more, they could be working at a deficit in their developer's fee, which does not give them then the opportunity to grow. It has been stipulated that maybe they could take some of their developer's fee and put it aside as a reserve to help build up those assets and liquidity, except it doesn't really exist. And that just cycle continues and continues, where the person will never get to the point, or the developer will never get to the point where they then themselves can then be their own guarantor. In this case, also something to consider is TLC is looking at about approximately $1.4 million developer fee. In reality, that sounds like a lot of money. And I know people will latch outside of the industry on that. What do they have to complain about if they're getting so much? We need people to think that that's continuing to keep that project affordable for 40 years. So if you take that 1.4 and divide it, in reality, this developer is looking at maybe the potential of $36,009 a year for keeping affordable housing and maintaining it in that place. And when you look at that number, take that perspective, it certainly is a little bit more eye-opening. Other considerations that we need to be made is, while we are trying to negotiate these guarantees, there's other pressures that are being put upon these developers that are not from PHFA or any other agency, it's from the IRS. Things such as placing service dates, meeting your 10% test. And then, of course, the lease up requirements and from the investors, which can lead to downward adjusters, which again, hit them on their developer's fee. So that developer's fee may look good. My story is it may look good. With the restrictions currently on the developers, in this particular case, a minority developer trying their best to revitalize community, he could in actuality end up with a negative developer's fee in order to bring this project to fruition. And with that, I will turn it over to Angela.
Thank you. So first, wanted to acknowledge our working group. I see many of you are in the session today. We have a working group of lots of industry professionals who've been meeting weekly, having conversations about this topic, doing some research, and really trying to think about how we create a solution to this problem. And their names are on the screen. And we really are grateful for everyone in the working group dedicating so much time to this endeavor. One of the things our working group did was to survey banks and syndicators to learn more about what guarantees they require, how they use guarantees, and just to gather more information for trying to create a solution. The top 3 findings were that there are some variable terms. We think that this is one size fits all, million liquid, 5 million net worth, but we found some variable terms. As Radha mentioned, that there were some variable terms for nonprofits. You could have as low as 500,000 liquidity and $3 million net worth. Some calculations could be even higher, using a percentage of total development costs to calculate net worth and to calculate liquidity. But all of that told us that there is an opportunity to do something different because it is not necessarily a one size fits all for the guarantees. The second key finding was that the focus really is on liquidity. Many of the respondents talked about how net worth can always be a little massaged to get a number that kind of meets your requirement. So the syndicators, investors really look at that liquidity to make sure that there's ample cash and cash equivalents to be able to address any issues, cost overruns, operating deficits, et cetera. And really the third key finding that multiple people have mentioned is that the guarantees are rarely, if ever, called. Most of the respondents, many said, I can never in my 30-year career remember ever calling a guarantee. Many talked about, at worst case scenario, that they have removed a GP, installed another GP, but without having to actually call these guarantees that they require. I put a quote from one of the respondents that I think sums it up nicely, that just says most of the time the GP does what they have to do without actually having to force them to do it through calling a guarantee and through the LPA. That was, again, echoed by many of the respondents, that we have this requirement, but if we're working with developers who really understand what their responsibilities are, that they take care of any issues without having to go through the process of calling a guarantee and really accessing that wealth, whether it's held by the developer or held by a third party. So that was a very eye-opening finding, that we have this barrier that we're not even really using most of the time. So all of that, these findings really kind of helped us hone in on recommendations to providing additional liquidity to minority-owned developers and women-owned developers who have demonstrated their capacity by securing a LIHTC award. Okay. So with that, Director Weitzman has joined us, so we'll turn it over to Director Weitzman.
Thanks so much. I really enjoyed everyone's presentation, and I'm delighted to be with all of you today. I think the last time I spoke with this august group, I was Secretary of Banking and Securities, but there's a huge change for me. Been more than a year and a half, and I'm thoroughly and deeply ensconced in housing and all things housing. I think you wanted me to speak for about 10 minutes or so. I do want to I don't know exactly who is in the audience so well. So I would like to just tell you what PHFA does. PHFA's mission, and I'll say it very briefly because I know I'm charged with speaking about the Developer Opportunity Fund, but the PHFA's mission is to provide affordable housing wherever possible throughout the Commonwealth of Pennsylvania. And there are two primary lines of business. One is single-family mortgages, affordable mortgages for individuals. And we have a lot of different programs. We actually have now a down payment assistance program, which we know is one of the most formidable barriers to new home ownership. And we just started it in March, and it's really, really going well. But we have an enormous portfolio that we service, and we have a lot of different products. We also have a mortgage foreclosure mitigation fund. We call it HEMAP, the Homeowner Emergency Fund, which is also often used. And then the other primary line of business is our multifamily development, which is providing affordable multifamily housing, primarily for renters. And this is where the Developer Opportunity Fund comes into play. The multifamily the multifamily housing program was spurred on by something which is referred to as the Low-Income Housing Tax Credit. So there are a lot of federal requirements in order to obtain these state tax credits in order to get the housing built. So we're very involved with that, as well as the management, supervision of the management of that housing once it is built. We want it to stay affordable for as long as possible. So those are the two primary lines of business. The one thing I wanted to mention, or an additional thing I want to mention, is that because of the pandemic, I certainly have not lacked for a sense of purpose and mission over this whole period of time, because the pandemic has really underscored just how important housing is to all of us. And as such, we were charged, the agency was charged with disseminating the CARES funding last year, which was the relief funding for both the rental and the mortgage assistance last year, which really it is very different than the American Recovery Plan, because that was strictly relief to help keep the economy moving and help keep people housed during the most acute initial phases of the pandemic. We have now been charged with administering the Homeowner Assistance Fund, which is for the mortgage program for the single family home ownership. And the Department of Human Services has been administering the rent relief. I just think it's very important. I know that in housing, one of the most significant challenges is really marketing what's out there and what's available. It's very hard for people to navigate it. So the more informed you all are about what we're doing, the better off and the more dissemination of information. So I wanted to mention those items to you. But there's no question that one of the, in addition to Home First, one of the most significant areas of recognition as a result of the pandemic has been the inequities and inequalities in our society. And so much of that starts with housing, redlining, inhibiting the ability to accumulate wealth in families who have been historically discriminated against, as well as the people who just haven't ever been self-sufficient for whatever reason. So we as an agency are being very intentional about our diversity and inclusion approach, or diversity and inclusion outlook, both internally in terms of the agency. It's fortunately been a pretty diverse agency, but also externally in terms of our partners and who we partner with, who we work with. So diversity and inclusion obviously is a 360. And one of the outgrowths of that has been looking at where there are needs in our economy or needs in our business. And we do want to foster development of small or disadvantaged, not just developers, but in all aspects of housing, but particularly in terms of development. When I first spoke to the Reinvestment Fund, which is a well-known organization in terms of their work in housing, when I first came into the role, which was 3 weeks before the pandemic hit, but they bemoaned the fact that a lot of community developers have disappeared and many have become were acquired or were not were overtaken by larger, more substantial institutional. So we not only have an interest for inequities, but we also recognize that local development and community development is really, really important. So I was not the primary mover initially on the Developer Opportunity Fund because it's been a concept for quite some time. But what the agency is trying to do, and I think the speakers have already indicated the working group, there are a lot of people really, really focused on this. But the agency's goal on this has really been to be a catalyst to provide liquidity for developers who might not have access at very competitive rates. And I'm so struck by it because it's like the people who can afford insurance don't need the insurance quite as much. It's the same thing. The people who have the wherewithal and development don't need the access to, but the people who don't are the ones, and it's the most difficult to find because there aren't those guarantees and there isn't that substantial balance sheet and all of that. So we really looked at it to try and see what the challenge was. And the challenge really is twofold. The challenge is access to capital, which has been emphasized here, but also experience. There are plenty that have experience, but it's getting the combination together that is so critical for the Developer Opportunity Fund to be useful. So and to be helpful. It's a little bit. I've had a number of conversations as recently as today with syndicators on this, and it's not. The real challenge is that people who have some experience have a harder time building on it because they've had to give up so much of their fee and haven't been able to make the same gains that other developers can. So we want to bootstrap that, help lift that up and help them have a better balance sheet and better liquidity. I am totally, this is a really safe asset class. I think Angela, you just talked about that. It's a really safe asset class. We don't, because we have a lot of requirements in the federal tax credit program, they're pretty buttoned down financing. This is not speculative investment. If they qualify through our housing finance agency, very likely we don't have many that don't succeed. So it's a pretty safe asset class. But as with anything else, people are looking to eliminate all risk, which of course is impossible. But the guarantees are an effort at doing that. But what we really want to see is, besides our own commitment to providing liquidity to developers, we hope it will be a catalyst, which is why I think we want to be part of your developing awareness of this. We want to be the catalyst so that there can be greater funding from the philanthropic community as well as the corporate community. We know throughout the pandemic at corporations and the philanthropic community have been saying over and over again, we need to invest, we need to eliminate all this disparities and inequalities. And this is one really tangible way for them to do it. It's an investment, even if it isn't a percentage return. What I have found out, of course, is that many corporations and whatever community, the community development areas do still require some sort of return. Our Developer Opportunity Fund is not requiring a return. But we also, we hope that the developers qualifying for it will make good use of it going forward. We're in the process right now. I can give you some of the specifics. We have committed 10 million of the agency's capital. We're hoping to leverage that to 50 with other sources. But we know that it's, when they're looking for 1 million of liquidity and a $5 million balance sheet, that there are other things that will probably come into play. But we can really get it, the boost. I don't know if I can refer to it as basis boost like we do in the deals, but we can give the developers the boost that they need for this. So we expect that it will be paid back over a period of time. We're in discussions about how long that needs to be in order to assure the tax syndicators for their investment. And I certainly expect that it's unlikely that it will be drawn down, but if it is, then it will get repaid at some point. We've talked about there being a fee, but we're not as focused on that as we are for accountability and actually success. That's the goal of it. The goal is not for us to make money on it, but to make sure that we have success. One of the things I want to point out, and I am very familiar with the TLC. Interestingly, I think a lot of I've become very aware of the deals that are easier to do versus those that are difficult. And I do know that a lot of the efforts by smaller developers sometimes are for the very, very difficult deals. So I'm very aware of that and very sensitive to that in terms of the agency. We provide a lot in the whole LIHTC process and a qualified application plan. We aggregate all of the potential resources, whether they're through some agency funding, as well as what we call subsidy layering for the LIHTC process. So there's a lot of involvement of the agency, and we're hoping, and our goal is to help really foster more active involvement, better qualifications for developers to be on their own in terms of these developments. So I'm happy to don't know if that was 5 minutes. I think it was just about 5 minutes. Happy to talk about it a little bit more, but I think I would ask you to really make people aware of the Developer Opportunity Fund. We want women-owned, minority-owned, and community developers who bring unique and important perspectives to their developments that really can benefit the design and construction before multifamily housing developments. And I think it's a really, really important initiative. And I'm hopeful that we will be able to really make this grow.
Thank you. We are very grateful to PHFA for really being a leader on this initiative and kind of making that commitment upfront to really jumpstart this program. So with that, we're going to open it up to questions. If you could raise your hand under participants, you can raise your hand and we'll call on folks, or if you are on video, if you want to actually physically raise your hand or put up a reaction with your hand, that's fine too.
We've answered all the questions, obviously.
Good.
But,
Great job.
This has been this has been in formulation for some time, and I'm really, really impressed with the working group and the earnest, intelligent effort of the people in the working group, and really your dedication to it. I can tell from the participants how heartfelt it all is. It's, as people had said, this is very bespoke. All development deals are very, very unique in their own way. So finding uniformity in the application of the Developer Opportunity Fund may be a challenge. We just spoke, as I said, I was just speaking to syndicators today, and it's like all of development. It's complicated, and it takes a lot of focus.
Vidhi, do you want to pose your question?
Thank you, Angela. Thank you, Director Weissman. This is Vidhi Anderson from Human Good. Could you speak to the timeline for when you think that you see the fund being available, and like when do you see like maybe the first deal kind of going through this process?
Right.
Thank you.
We have. I think the challenge that we see is that, and what I understand from the syndicators, is that there's no drop dead date for when the deal will come together. But I am hopeful that through this cycle, we know we have one developer who's looking for some support in order to get in order for their lender to lend to them. This is a much more straight up deal. It's not even a tax syndication. And it's possible we might be able to do that. But I'm hopeful that from this cycle that we might be able to, the cycle we're currently looking at, which I expect will probably get done the end of October or November, hopefully this year.
Thank you.
I was stunned, Vidhi. I mean, it's not new, but the time for development is so long, right? And it's really, if I had one wish, it would be like, could we speed everything up a little bit? But it takes time.
I think we all will appreciate if we can make that process a little shorter somehow. So thank you for all that you're doing.
Yeah, and I'm working on that. By the way, Blaine, I see that you want to ask a question, but if I could just articulate that, I think I'm really working on re-engineering our multifamily process. The agency is going to have housing forums, 3 of them actually. I'd hope they would be in person. But I think they're going to have to be virtual given the variant. In September, we'll have a number of them. So we're going to be looking for some of the biggest and best ideas from our developer community at those forums.
That's great. Thank you.
Blaine?
My name is Blaine Stoddard. Can you hear me?
Yes.
I run BFW Group, which is a construction project management company, and also I run RB Development, which is a affordable housing development company. And I just want to make a comment, Director Weissman. As you know, I was one of the first to call you and the first to probably be a pain. But I want to thank you. I want to thank you for all the change. I want to thank you, number one, for the Development Opportunity Fund. I want to thank you for listening to us in the marketplace about what the needs are in affordable housing, because the next crisis in America is after COVID will be an affordable housing crisis, and it's here. And last but not least, I want to thank you for making, promoting or supporting or helping to make change at the board. As you know, I've been raising hell about integrating the board from a racial standpoint. I just want to publicly thank you. We look forward to working with you. We're excited about the Developer Opportunity Fund. I promise you, we will get some banks to put some money into this. And that's a promise we're making. And we look forward to working with you. I have a lot of questions, but I talk too much. So I'm going to turn it back over to Angela Steele.
Angela, can I just respond on that for a second? Because Blaine is so right. I mean, this is going to be an effort, an initiative that requires persistence. And one of the things, when I first came into the agency, I thought there's so much untapped potential in terms of all of the money in the world. There's so much money now, so much wealth, right? And there's so much opportunity. And PS, people do get tax benefits from contributing it, CRA credit in the banking community for contributing it. It should be a piece of cake, right? Easy peasy, right? But what I've discovered, not just in terms of their mandate for a return, but the real issue is, the real challenge is every foundation, every corporation has their own vision about how the money ought to get spent, rather than saying, where can we disseminate it? Like if I dare say, like the federal government is now saying, we want these priorities, but you're going to administer it. It's very hard for us to have square pegs fit into round holes. And that is kind of where the corporate community and the foundation, and I don't fault them. They have their fiduciary responsibility. They have their corporate objectives and all of that. But I just like it to be a little softer money. And I think if there's anything from an advocacy standpoint that you all can do when you talk to the chambers or you talk to these corporations, is say, just put it into something that's reasonably structured. You will get your investment return. You're not going to get your 12% in the stock market, but the investment in our society and in affordable housing and eliminating wealth disparity is well worth it. And the more you all can, and we all can communicate that, I think the better.
Well said. Derek?
Yes. Hi, my name is Derek Tillman. I'm President and CEO of Bridging the Gap Development. We're a development company based out of Pittsburgh. My question is...
Derek, I remember you from meeting with you and Dennis Davin. I love your model. And I was just talking to people about you expanding your model just this week, by the way.
Well, that's awesome. I'm glad to hear that. And I just want to thank you, Director Weissman, as well as this committee, again, just echoing Blaine's comments for this program. I know the focus is to raise the $50 million. Through any of you all's conversations, has there been any different kinds of thought processes, like working with syndicators or investors that say, hey, we're not going to contribute cash, but we can make a contribution in terms of maybe having a lower liquidity or net worth requirement? Has any of those conversations happened? Or, yeah.
I'm not in the best position to answer that because I think the working group and others have had more conversations about that. I do, my instinct is that but it's pretty tough in terms of guarantees because that's where the financial standards are at the moment. I shouldn't say the standards. Well, they would say actually the tax credit standards require it more, but it's more their priorities in terms of really, really tying it down. So I don't know if I can be encouraging about that. That takes moving financial services, a significant part of the financial services environment. So others might have may have had some of those discussions, but my sense is that the requirements seem to be, they will say that the association requires that. That's what they're relying on. If somebody wants to say that that's more, that the data doesn't support the need for that, for the tax indicators, that's a possibility. But I would suggest that the working group has better responses than I do.
So a conversation that has come up several times is engaging AHIC, and I'm going to forget what that stands for, but it is the kind of council that advises on how the LIHTC program should be structured and what investors should be asking for. And it's come up several times to really lobby AHIC, because if AHIC were able to change their approach to guarantees, then investors and syndicators would be more likely to accept different, potentially lower guarantees. So we have not directly started that advocacy yet, but it has come up. I would say we haven't specifically asked investors if they would be open to changing their guarantees, but it's something down the road that I think is probably inevitable to think about. If we're not using these guarantees, are they really necessary?
And that's the association I was referring to, Angela. You just remembered the name better than I did.
Someone can put in the chat what it stands for.
Yeah, right.
I have a question. So I apologize in advance if this is the basic up level of questions, but I heard the $10 million funding number. And I think I also heard in response to Vidit's question that there isn't yet a standardized process for application and an approval, or maybe I heard that wrong. I guess the source of my question is, what's the board or governing body that looks at applications or projects to determine who would qualify to be able to get some of this money?
We have a term sheet that is being reviewed by the working group, and we're getting input now from the tax indicators as well. I previewed my comments a little bit by saying we're in a little bit because what's the theory? Continuous improvement. The term sheet that we have put out is not set in stone, so I can't refer you to an application on our website yet.
Okay.
And my guess is that as many developers there are going to be that many different situations, but we are working with it. I think the most challenging thing for us that I've heard from the tax indicators, and as I said, we're not looking for a big return. We want to bootstrap and be helpful. The biggest challenge is the length of time now that the syndicators are looking for. In terms of the amount of time that liquidity facilities should be available.
Oh, by the way, I see so many familiar faces. I didn't say my name because I knew a lot of faces, but my name is Karen Harris. I'm a audit partner at Cohn-Resnick. And my question was, because I'm sure that, we see this money, and as working with clients and trying to balance sources and uses with issues with trying to fill gaps, that fund is out there as a carrot, and I just field questions all the time. Well, how do I get access to it? How do I, how do I reach it? And so that was kind of the premise of my question. Unlike Darren, who's smiling, he knows that the fund very well because we work together. But there's a lot of different, developers, smaller, bigger, that may want to have access to that. So I just want to be prepared for that question.
Yeah.
This is Elaine McGill. I'm with Cinnair, which is on the syndication side. I'm based out of Pittsburgh, but I underwrite projects in a number of states. But I just wanted to really echo that I would certainly agree, and I'm happy to be involved in conversations with AHIC. I would certainly agree that is a place where a lot of investors sort of look to as kind of an industry standard. You know, not necessarily for permission on things to do, but I think if there is macroscopic advocacy to be done about really aligning real risk with real belts and suspenders rather than sort of imagined risk. I think that's absolutely a great place to do it. And I'm happy to sort of raise my hand to play a role in that.
That's become really clear to me that that's a place that's an area that could use some work. I want to mention something else too, in terms of the model, if you will. I don't think it has to be the same for everybody. If there's a corporation or a organization or a foundation, if they want to set it up their own way, I view it as sort of, this is a developer opportunity fund, and we can have different modules. If somebody wants to set it up a certain way, let the market decide what the developers want to take. Be the most competitive as you can be. But if you have certain requirements, just make it available. You can put your terms out there, but make it available, dedicated to it. And you know, try to be as flexible as possible. But if you have certain things that you have to do as an entity, so I don't think it requires uniformity. I think PHFA can have its structure. Blank Foundation can have its structure, and Blank Corporation can have its structure. They don't have to be structured the same. Doesn't need to be the same. It doesn't have to be a syndicated loan. It can be different, but to have it under an umbrella of opportunity.
Vidya, do you have an additional question?
I do, but I cannot see. I'm on my phone, so I cannot see if there are other people who have questions. So I don't want to.
Oh, you can go ahead. Go ahead.
Well, I also wanted to ask, I felt like this would be a missed opportunity if we did not ask a question about the 9%. So I don't want to, can I ask?
Go ahead. Go ahead.
So Director Weissman, could you share some light on when you think the awards would be announced for the current round and the next round? I feel like this question has to be asked before 5:30, and we were getting close, so.
Totally fine. Totally fine. I think about our
I
schedule.
waited till a respectable time, but I was like,
Right.
we cannot end this.
Right, right. So just from a historic perspective, last year, I was thrilled, you know, when the pandemic first hit, it was like, are we going to be able to do this? Are the developers going to be able to do this? What's going to happen? Fortunately, things stabilized. They didn't become in person. And, you know, all of the supply chain disruptions and changed assumptions and all of that, you know, existed, and are continuing to exist. But we were able to get our awards out last year, about a month later. Now coming full circle, so we put out the request and extended it for this cycle till March, as opposed to, I think, the February it typically has been. So we had a month delay there. In the meantime, and appropriately so, we have a number of other resources that we're working on allocating. And as you all know, these are like putting squares in round holes because they all come with their own requirements. But we're currently in the process of assessing and allocating additional resources that have been given to the housing industry. We have additional HTF funds now. We have, we will have a state tax credit that got funded. And we have the CCRP money, which I can't believe it, but I think the way the state applied for it requires it all to be, all the CCRP to be in qualified census tracts. Don't faint over that yet, but what that means is it's going to require a more specific application in terms of how we apply it. But so we're working on all of that to get these deals to closing, to continue the pipeline. At the same time, we have been going through all of the scoring for all of the applications. And I expect, I'm hopeful that we'll have a lot of closings in October. I'm planning on these forums in September and having and I expect the awards will probably be in October. That's our goal, for them to be in October.
Okay.
And
Thank
last
you.
year, I can't even remember because we've been so busy. I don't remember. I think the QAP went out in November and we did the awards in August. So we have definitely, because of all of the different work that we've had to do, you know, we definitely lost some time on it, but I'm happy that we're moving ahead with it.
Thank you. Sounds good.
And then if we get the QAP out in November, like we did last year, you know, hopefully we'll know, you know, we're not changing the cycle dramatically. You know, hopefully we'll be able to just stay on track. And hopefully the supply chain keeps up with it, right? We've seen all the changes in that already. Somebody said, buy domestic, just buy domestic, right? Or source domestic, which is impossible for appliances, right? I mean, am I entertaining you, Blaine?
No, I'm a member of the planning group for the Developer Opportunity Fund, and we said we would not talk about the QAP. We said we would not,
okay.
but
Yeah.
Vidi is, I
Yeah.
totally agree with Vidi, because, you know, it's the elephant in the room. And by the way, do you know when the next application will be due?
I don't know that. I need all your input on the QAP. I'll be putting out a press release pretty soon on the forums. And I really want people, so I'm not, you know, I don't mind you asking, but I, of course, you know, you should know what we're thinking. And I think that's important. You'll also have to recognize that we're all human beings and things might shift here a little bit and a little bit there, you know. It just goes with the territory, and right now continues to be a really challenging time with the variant, and I know changes in pricing, et cetera, so it's so much fun.
Well, I think with that, we will wrap up. Again, Director Wiseman, thank you very much for your time. Thank you for your leadership on this issue. Everyone who's here today, if you are at all compelled by the presentation, what we've heard today, we do ask that you share this information, be partners in the advocacy work. We're going to get Elaine to start a campaign for AHIC, so definitely jump on that. But this is, you know, very important work, and we hope to create opportunity for more developers to be able to participate in the LIHTC program. So thank you all. Have a good evening.
Spread the word. Thank you.
Thank you.
Thanks.
Thank you.
Be well.